Today, we'll calmly examine 3 key reasons why it makes sense to trim back US equity risk now. First, stock valuations are highly stretched. Second, market leadership is extremely narrow, dominated by just a few mega-cap tech names. Third, the macro backdrop feels fragile. The Fed-driven yield curve, narrow credit spreads, and ultra-low volatility signal potential blind spots. So we're not here to hype doom or promise gains, but to help investors like Brian and Tony, in the example we've seen, think through the risks rationally. I'm Romain, and at XO Capital, we focus on sober long-term success, not clicks or quick fixes. Let's begin with stretched valuations. On screen, you see the picture. The S&P 500's forward price earnings ratio is around 22-24, among the highest readings in decades. UBS notes this places the forward price and earning ratio in the 19th percentile of the last 20 years. In plain terms, investors are paying a lot per dollar of expected profit, roughly as much as they did near the 2000 dot-com peak or the 2007 credit-fueled peak. Some argue today's growth prospects, especially from AI and cloud computing, justify sky-high multiples. But we should at least acknowledge history. The Shiller CAPE, the cyclically adjusted price and earning ratio for the S&P, now sits near levels last seen in 1999 and 2021. It's actually at its third highest level ever. In other words, only the late 1990s tech bubble and a brief post-2020 spike were higher. Legendary investors warned about this. Warren Buffett's Buffett indicator, total market cap divided by GDP, is above 213% today. Buffett long warned that readings above 200% mean investors are playing with fire. We are clearly in the fire zone territory. What about earnings growth? It's true many S&P companies have beaten forecasts. Some tech profits are booming, but current valuations already embed very optimistic growth. Using a more mechanical measure, Professor Aswath Damodaran notes that S&P 500 earnings yield, the inverse of price and earning ratio, has actually fallen below the 10-year treasury yield. In effect, you'd get more yield from a risk-free bond than from the stock market's earnings. On a forward basis, Damodaran estimates stocks still offer only a modest equity risk premium, around 4.3%. In simpler terms, by some models, US stocks seem modestly overvalued, possibly 10%, 15%. What are the key valuation metrics for September 2025? We've seen a S&P 500 forward price and earning ratio around 22.5, so that's the 19th percentile historically. Shiller CAPE around 37-39, the third highest ever. Market cap divided by GDP, the Buffett indicator, at 213%, and earnings yield inferior to 10-year treasury, negative implied ERP, like we mentioned, like we can see. These are eye-opening. Such rich valuations leave little margin for error if something goes wrong. So in this example, we have Brian and Tony. Brian being a tech enthusiast investor, saying to Tony, Apple, Microsoft, Nvidia, their growth still looks unstoppable. When these giants beat every quarter, who cares what the P/E ratio is? Tony replies quietly, let's remember 1999, Brian. Big tech can outperform for years, sure. But even then, the bubble burst. Right now, the math looks more like it did in late 1999 or late 2007 than in calm 2019. Look, forward EPS estimates have actually risen to all-time highs as of mid-2025. This means companies are forecasting record profits, which helps justify part of the rally. But it also means much of that hope is already priced in. You can't have a price and earning ratio of 23 and still assume big multiple expansion on top of that. That's asking for perfection. Maybe, but dividends and buybacks are high too, and if the Fed cuts rates next year, the higher multiples make sense. Sure, maybe the Fed cuts, but the Fed isn't a magic wand. Even UBS notes that historically, an elevated price and earning ratio alone rarely dictates immediate direction. In 1999 or 2021, high multiples didn't stop stocks from rising, but those gains were driven by very strong profits and often followed by corrections. We can't assume just because we've been at high price and earnings before, it will repeat again without pause. On screen, you see the Shiller CAPE trend. It creeps up to about 38, roughly matching the late 1999 peak. That graph underscores Tony's point. Valuations are near bubble territory. In short, valuation is our first caution flag. It doesn't force a crash tomorrow, but it means investors have paid dearly for future growth. If growth disappoints or rates don't fall as much as hoped, that rich price can reverse quickly. Let's switch to leadership. If we break down index returns, the S&P 500 and Nasdaq's gains have been very top-heavy. As Liz Ann Saunders of Schwab notes, the Magnificent Seven, Apple, Microsoft, Nvidia, Alphabet, Amazon, Meta, and Tesla, now account for roughly 1/3 of the S&P's market cap. In fact, data from Ned Davis Research show those 7 make up nearly 34% of the S&P 500. An extraordinary concentration. 10 years ago, they were 10%. This means if these giants do well, the indexes go up. If they stumble, the indexes take a beating. Meanwhile, most other companies hardly move the needle. Schwab charts show only about 5% of S&P 500 stocks are at 52-week highs now, even as the index itself is near all-time highs. Over 95% of stocks are not breaking out with the market. That participation gap means the rally really is just about the few big names. But hey, isn't that fine? We want to own the big winners, right? Perhaps, but it's worth remembering how hard it can be to time that. For example, Schwab points out that many of these Magnificent Seven are actually not the best performers this year on a stock-by-stock basis. It's only that they are so big that their moderate moves dominate the indices. Now, consider the Nasdaq 100 QQQ ETF, even less diversified. On screen is the breakdown of its top weights. Nvidia, 13.4%, Microsoft, around 12%, Apple, 11%. Those three alone are roughly 36% of the Nasdaq 100. If you include Amazon, Meta, etc., the top 5 hit about 50% or more. In fact, the top 10 stocks account for roughly 70% of the index. You can see that numeric list on Slick charts. So QQQ is essentially a mega cap tech fund. It's great when those big names rally, but it's exposed if even one or two wobble. By contrast, an equal weight S&P ETF, Invesco RSP, spreads out the risk. Last few years, RSP lagged cap-weighted SPY because its smaller stocks couldn't keep up with the tech mega caps. But in a reversal, if tech slips, RSP might hold up better. The key point, high concentration amplifies risk. So let's sum up market concentration issues. The Mac 7 share represents 34% of S&P 500. Only 5% of S&P stocks at 52-week highs, most gains from few names. The Nasdaq 100, top 3% represents 36% of weight. The top 10, 70%. QQQ is very narrow. The equal weight S&P RSP underperformance shows how cap-weighted SPY's gains were almost all from mega caps. So let's go back with Brian and Tony again. Tony says, you remember how in early 2020, virtually all stocks crashed together? That was broad. Now, though, very few are keeping pace. A small tilt in any one big stock, say Apple after an iPhone miss or Nvidia on an earnings scare, could drag down the whole index. But Apple and Microsoft are cash machines. They won't drop 50%. They are winners. They are robust businesses, but robust businesses can still go down in price if sentiment shifts. Remember 2022? Even Amazon and Google fell 20-30% despite long-term strength. High profit today doesn't mean stock price is invincible. When valuations are high, even a strong company needs near-perfect execution to justify its price. Indeed, market data backs Tony up. The weight of tech in broad indices has never been higher. If, for example, 4 of the Magnificent 7 see a 20% pullback, not unimaginable in a correction, that alone could shape about 7% of the entire S&P 500. At that point, even average stocks would have to outperform just to keep up. In practical terms, a widely diversified portfolio with smaller and value stocks, bonds, etc., is certainly less exciting in a roaring tech bull, but it also has less single-point risk. We highlight examples like QQQ and RSP simply to illustrate RSP versus SPY or QQQ versus broad market. The lesson is that today's rally owes a lot to mega cap tech. If that changes, the broader market could follow. Finally, let's look at the macro picture behind the bull market. We're in a Fed-driven era, and some indicators feel precarious. First, recall the yield curve. For 2022-2024, the 10-year minus 2-year Treasury yield was deeply inverted, signaling recession fears. So we've seen the 10-year Treasury minus 2-year Treasury being below minus 1% in March 2023, again in June 2023, now being above in the positive territory to 0.6, like mentioned previously. We know the term premium, the extra yield for holding 10-year bonds versus rolling short rates, is still very low. According to New York Fed models, the 10-year term premium is only around 0.7%. This is hardly above zero. It implies almost all of the long yield is explained by expected Fed moves with little extra cushion. A tiny shock like inflation surprises, fiscal worries could send real yields higher or disrupt forecasts. Turning to credit markets, spreads have widened during ICOPs. In April 2025 sell-off because of tariff scare, US investment grade spreads jumped about 12 basis points and high yield jumped about 37 basis points. Those are not record levels, but they show even a relatively short stress event made borrowers pay more. Compared to the tight credit conditions of late 2023, there's noticeably more risk sensitivity now. If a real downturn materializes, spreads could widen much more, squeezing corporate profits and equity valuations. What about volatility? The VIX, the fear index, remains surprisingly calm. In fact, it's been under 15 for most of 2025, well below its long run average about 20. That low VIX tells us market participants have been selling volatility, shorting VIX futures in record size. So hedge funds are essentially betting that nothing bad happens. Yet history warns that calm can reverse quickly. The document above notes a 120% VIX spike in April 2025 wiped out many short vol positions. To sum up macro red flags, we have the yield curve 10-year minus 2-year, that is in recession zone, if we can say. The term premium, 0.7% on the 10-year, meaning bonds offer very little extra carry beyond Fed cuts. Next is credit spreads, narrow but within in April, with investment grade spreads jumping about 12 basis points and high yields jumping about 37 basis points. Any real credit stress could push them much higher. Volatility, we have a VIX below 15. Record net short VIX positions indicate complacency. So what would say Tony about that? Brian, banks still have strong capital, but this long inverted curve, it's only just normalized. We haven't seen actual yield curve steepening yet, which would support a true expansion. Until then, we are walking on a tightrope. True, but bond yields actually fell in August, showing markets expect softer landing. Or maybe they're just complacent. The Fed reduced expectations of future hikes, but they're not committed to big rate cuts without risk. And if something else, inflation, China, geopolitics goes sideways, that curve could invert again or even spike. Meanwhile, credit is like hydrogen gas, invisible now, but volatile if sparked. This all suggests the environment could stay benign for a while, and indeed equity markets have relied sharply on Fed polls news, but the fragility means policy is precariously calibrated. Investors are, in effect, making lemonade out of high valuations by assuming smooth macro conditions. That's a bet worth questioning. Many investors have heard narratives like valuations don't matter anymore or AI will save us, and it's worth addressing them. Let's break down two common myths. Myth, high valuation signals are irrelevant. Growth justifies any price. Reality, growth can support higher price and earnings ratios, but history shows extreme valuations often precede poor returns. For example, UBS points out that while high price and earning ratios alone doesn't tell the whole story, strong earnings momentum and Fed support ultimately drove rallies in 1999 and 2021. In years like 2000 and 2008, though, high valuations meant stocks fell. We shouldn't assume this time is different without evidence. Next myth is AI boom means megacaps will surge forever. Reality, AI is indeed a revolution, but it's not an earnings guarantee for every chip or cloud company at any price. Nvidia's growth has been phenomenal, but even it must deliver real revenue for every dollar of valuation. If the economy slows or competition hits up, even AI leaders will face normal business cycles. Beating everything on an optimistic narrative ignores the possibility of setbacks. Last myth would be big tech is diversified and cash rich, so it can't go down much. Reality says today's giants have many businesses and cash cushions, which is great, but their stock prices have already priced in that strength. In the Nasdaq.com article we read, analysts note that stock index concentration is a long-term trend, not an aberration, partly because these firms are powerful. Yet, even powerful companies can underperform if their multiples compress. No company is immune to investor sentiment changing. It's fine to recognize tech trends, but we must also respect valuation math and history. Even ardent bulls will say valuations matter eventually. So let's state a calm, measured takeaway and where we go next. Valuations are rarefied, leadership is narrow, and the macro dashboard, curve, credit, volatility, isn't flashing green. None of that guarantees a drawdown, but together it leaves very little margin for error. In that kind of market, prudence beats bravado. Trim the most crowded exposures, prefer quality over story stocks, hold some optionality in cash or short duration, and be intentional about how much broad beta you carry. The critical layer here is policy. Markets now assume a second rate cut in October. Cuts can be supportive, but context matters more than the headline. Are they arriving into broadening growth and improving earnings breadth, or as a response to cooling activity and tightening financial conditions? When multiples are elevated and participation is thin, the answer to that question often determines whether easing extends the cycle or simply cautions volatility. Our stance stays the same. No melodrama, no hero calls. Stay invested, but adjust the sails. Let the fundamentals, not fear or FOMO, set position size. If conditions improves, earnings reaccelerate beyond the top names, and the equity risk premium widens for the right reasons, we can lean back in. If not, incremental de-risking and smarter hedges are rational choices. Following, we'll zoom out and test this setup against history, what typically happens when the Fed begins cutting into expensive markets with narrow leadership. We'll walk through prior cycles, the downside math of modest re-ratings and EPS shocks, and the specific signals that will either validate caution or argue for adding risk. Speaking about policy, we must mention the Federal Reserve's key policy tool is the federal funds rate target, which it raises or cuts to fulfill its dual mandates of price stability, low inflation, and maximum employment. These goals can conflict. High inflation calls for higher interest rates to damp demand, while rising unemployment calls for rate cuts to stimulate hiring. As one analysis notes, the Fed's best weapon for fighting high unemployment is to cut rates. In practice, lowering the Fed funds rates makes borrowing cheaper for consumers and businesses. A cut translates into lower mortgage, auto, credit, and business loan rates, encouraging spending and investment. In short, Fed cuts are intended to support growth and jobs by reducing borrowing costs and invigorating the economy. Historical precedent shows the Fed aggressively cuts rates during crises. For example, 2001 dot-com bust and 9/11. In 2001, the US economy was already weakening when the September 11 attack struck. Fed transcripts later revealed officials felt a patriotic duty to ease policy. Over that year, the Fed slashed its target rate 11 times, taking it down from 6.5% in early 2001 to 1.75% by December 2001. 3 cuts even came between normally scheduled meetings. 2007 and 2008 great financial crisis. As the housing market and banking system unraveled, the Fed cut rates repeatedly. According to Reuters, after the first cut in September 2007, the Fed cut rates 7 more times over the next 15 months. By December 2008, it had driven the federal funds rate down to near zero. Notably, Fed purchases of mortgage bonds, the known quantitative easing, also began at this time. In 2020, the COVID-19 pandemic, in early March 2020, the Fed reacted within days to the coronavirus shock. It held back-to-back emergency meetings, March 3 and March 15, and cut the rate by a total of 150 basis points to near zero within 2 weeks. For perspective, that was extraordinarily fast. In 2008, it took the Fed 15 months to cut rates to zero, whereas in March 2020, the Fed achieved the same in just 2 weeks. Each episode underscores that deep downturns see Fed easing. As Reuters observed, from the first crisis fighting interest rate cut to zero rates, the Fed took 15 months in the last crisis. This time, it took 2 weeks, comparing 2008 versus 2020. Outside those extremes, the Fed has also cut rates to guard against slowdowns. For example, in the early 1990s recession or mid-1990s Asia-Russia crisis, or to bolster the economy, like in 2019 cuts amid global slowdown. But the magnitude and speed of cuts during crises like 2008 or 2020 dwarf normal policy moves. By early September 2025, US growth was moderating and inflation, though down from pandemic peaks, remained above the Fed's 2% goal. The labor market was cooling. Chair Powell noted on September 17 that
while the unemployment rate remains low, it has edged up. Job gains have slowed.
Inflation has been easing but still runs near 3%. The Fed's summary economic projections median for 2025 PCE inflation is 3%. With weaker jobs and sticky, albeit falling inflation, Fed officials have shifted their focus toward employment risks. In Powell's words,
and downside risks to employment have risen.
And with that balance of risks changing, the FOMC cut its policy rate by 25 basis points on September 17 to a 4%, 4.25% target range.
At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4 to 4.25%, and to continue reducing the size. Changes to government policies continue to evolve, and their effects on the economy remain uncertain.
Policymakers made clear this easing is likely to continue. Chair Powell said more cuts will follow at meetings in October and December. The Fed's updated projections confirm this easing path. The September summary of economic projection dot plot shows most participants envisioning lower rates ahead. The median dot for year-end 2025 is about 3.6%, down from 4.1% today, and about 3.4% by end 2026, implying roughly 2 quarter points cuts in 2025 to bring the rate into the 3.75-4% range and another cut in 2026. In other words, even after these cuts, the Fed funds rate stays well above the 2% longer run level, underscoring that policy remains unusually restrictive by historical standards. Markets have quickly aligned with the Fed signal. SME FedWatch shows roughly a 90% probability of a 25 basis point cut on the October 29 FOMC and about 65% odds of another cut in December. In sum, traders are betting on 2 cuts by year-end, which would take rates to roughly 3.75-4%, and even a meaningful chance of a third cut in early 2026. The expectation of moves into the 3.75-4% range has been a key focus for markets. Lower anticipated rates have helped lift financial asset prices. As one large investor note explains, lower policy rates boost equity valuations. Reducing discount rates raises the present value of future earnings, and the decline in bond yields widens the equity risk premium, making stocks more attractive. Similarly, rate cuts provide a supportive signal to investors, bolstering market sentiment and risk-taking. In practice, bond yields have already fallen as Fed cuts were priced in, and US stocks have rallied on hopes that the slowing economy can still avoid recession. All told, by late September 2025, the narrative is that the Fed is pivoting from highs to an easing cycle, with 2 cuts essentially baked in and possibly a third by Q1 2026, a path consistent with a careful search for a soft landing. When the Fed cuts its policy rate, the immediate effect is to reduce short-term borrowing costs for banks. This generally leads to cheaper loans for households and businesses. As Reuters explains, a lower Fed rate should translate to cheaper borrowing costs for most kinds of loans. Consumers may see lower mortgage rates, auto loan rates, or credit card rates, and businesses face cheaper financing for investment or hiring. For example, after the Fed's 50 basis point cut on September 18, 2024, analysts observed that 30-year mortgage rates had already fallen from near 8% down to about 6.2%. Mortgage rates often move ahead of Fed actions because lenders anticipate policy shifts. Personal loans and credit cards are tied more closely to the policy rate, so those typically begin to come down shortly after a Fed cut. In short, a quarter-point cut now would be expected to slightly lower borrowing costs. Home buyers could lock in modestly lower mortgage payments, businesses could refinance or take out cheaper loans, and some consumer debt burdens would ease. Lower borrowing costs are intended to stoke demand. Cheaper credit encourages consumers to spend and businesses to expand. This, in turn, can slow or reverse a job slowdown. Fed officials' goal is to engineer a soft landing, guiding the economy so that inflation returns toward 2% without causing a recession. As one Reuters commentary notes, the Fed hopes to keep the economy like that, avoiding recession, by cutting rates, which makes it less expensive for businesses and households to borrow and therefore spend more freely. In other words, rate cuts are aimed at bolstering hiring and spending just enough to counter the cooling trends in the job market. However, it is important to note something. Rate cuts have varied effects depending on broader conditions. Historically, when the Fed cut rates during ongoing growth, non-recession, markets often responded positively. Stock usually rose after the first cut, on average 14% 6 months later. But if a cut occurs during a recession or a severe downturn, stocks often continue to fall even after the cut, on average around -4% over 6 months. In other words, a Fed cut is generally good news for markets unless it is a sign that the economy is already in trouble. In today's case, the hope is that the economy will avoid recession, but there is no certainty. Likewise, rate cuts can eventually fuel higher inflation if the economy overheats. For example, after the Fed eased policy sharply in the late 1960s, high inflation followed a few years later. Modern Fed officials will carefully monitor inflation and wage data to ensure that cuts do not reignite price pressures. As one Fed watcher put it, a truly smooth soft landing, reducing inflation without a recession, is rare. As KPMG economist Dwayne Swank observed in September 2024, we have never achieved a soft landing in the wake of an actual bout of inflation. Another reason Washington policymakers have argued for rate cuts is international divergence. By mid-2025, other major central banks had already eased policy significantly. For instance, the European Central Bank and Bank of England had cut rates multiple times, on the order of 10 times each, while US rates remained unchanged for much of 2025. This has led some observers to claim the Fed was behind the curve. Given that US inflation was no higher than in Europe, Fed officials, however, point out that unique factors like US tariffs have kept US inflation higher relative to trading partners. Even so, because US rates had been so high, markets viewed September 2025 as the Fed finally beginning to converge with global easing. Indeed, after the first cut was announced, futures markets quickly priced in the likelihood of further cuts. In fact, a Reuters poll, October 29, 2025, taken a year earlier, had all 111 economists expecting quarter-point cuts at the next two meetings, showing how consensus had shifted to anticipating an easing cycle. That poll was in the context of 2024, but it illustrates that when the Fed pivots to cuts, economists often expect multiple cuts in succession. In 2025, the story is similar. Analysts now generally expect the Fed to deliver a sequence of rate cuts through autumn. Putting this all together, the Fed's near-term path is set for easing. As of October 2025, the Fed has already cut 25 basis points in September. In October, at the end of this month, we'll see another cut bringing down the rates to 3.75 to 4% range. What happens next will depend on data. Fed officials will watch inflation readings and job growth into 2026. If inflation continues to moderate and the labor market shows strain, more cuts could follow. If inflation unexpectedly turns back up, the Fed might pause or even raise again, though that seems unlikely in 2025. But not in 2026. Key takeaway for this video would be Fed rate cuts lower the cost of borrowing, which tends to boost consumer spending and business investment, supporting jobs. Historically, the Fed has slashed rates aggressively during economic crises, 11 cuts in 2001, 8 cuts in 2008 down to 0, 2 huge cuts in 2020 to 0. In each past cycle, cuts were aimed at preventing downturns and spurring a recovery. Today's Fed is acting in that tradition. Economists caution that soft landings, avoiding a recession while beating inflation, are very hard to achieve. The Fed will be trying to thread that needle in 2025-2026, easing policy to help employment while keeping inflation on track. All else equal, Fed cuts would likely cause bond yields and mortgage rates to fall. Mortgages already eased from 8% to 6% after the first cut, and could lift stocks if the economy avoids a downturn. Historically, stocks rally after cuts in non-recession periods. In summary, by autumn 2025, the Fed had signaled a shift from rate hikes to a modest easing cycle. The immediate effects, cheaper loans and support for hiring, are generally positive for the economy. However, the Fed must proceed carefully. As history shows, easing too aggressively can overheat prices, while easing too little risks tipping the economy into recession. The coming months will tell whether this round of rate cuts can achieve a gentle landing, as Fed officials and markets hope. If you're looking for strategies in those uncertain markets, feel free to watch our video explaining our hedging solution using prop firms to make profits on the markets.